Hi guys, it is 11:34 on Friday the 5th of August 2022 and the market is open. It's continuing a gradual climb upwards. I think it's what I would call a recovery. If I slide this down a bit, you can see what I term the opportunity gap. Where basically the market should be if it had continued on that trend line, and where I expect it probably will recover to in time. Just looking at the portfolio value, you can see on the right here that we're currently positive at just over 4.5%, and I thought I would just like to take a moment and demonstrate to you the real value of dollar cost averaging. So to do that, if we go back to the beginning and have a look at where we were at the start. So I started this FIRE journey 17 weeks ago, 18 weeks ago, something like that. Here you can see it. So the 8th of April, we invested the first £120, and at that time the fill price, the price that that settled at, was 65.54. So let's just have a look at that. So 65.54 thereabouts. I'm going to bring this into a 4-hour time frame. Remember, it was the 8th of August. You can see the months along the bottom there. Oh, sorry, 8th of April. So there's the 5th, 6, 7 and 8. Okay, so the 8th was somewhere around here. So this was the point that we bought in at. Now if you look at the blue line just below, that is the current market price, and as you can see, it's less than the point that I bought in at. Our average price over here on the right, as you can see, has come down from the initial 65. It's come down to 62.07, you might as well say, currently. And the significance of that is that when the market continued downwards and we continued to invest, we effectively reduced the average price. So rather than sitting on that initial investment and not doing anything, by continuing to add funds to the portfolio, the average price has fallen. And even though the current market value is less than the point that I had bought in at back on the 8th of April, even though the current price is lower, we are sitting in the green by 4.5%, which is pretty good. Now, that being said, remember that this was a new investment, and as time goes on and as you have more money invested, you're less able to cause that kind of change, and that's simply because if you have only £100 invested and then you invest a further £100, you have doubled the investment, and hence you could or you should be able to have basically any change in price. What I mean is let's say the initial price that you bought in at was 50. Let's say that doubled, highly unlikely, but let's say it did for the sake of argument, and it went to 100. Well, when you put in that second investment, then your average price will go to 75, midway between the two. However, if you have 10,000 invested and you invest a further 100, proportionately that's an awful lot less. That's is it 1% of your initial investment, and you will not see the same effect. It still happens. It's still beneficial, but you're not going to be able to influence the average price by just as much. But there you go, guys. Just a bit of an illustration to let you see that buying when the market is falling is not a negative thing to do, not by any stretch of the imagination. And in fact, when you look at how quickly things take off when the recovery does actually start, you know that's growth that you don't want to miss out on, and for that reason, I think that's why the proven best strategy is to consistently buy into the market, irrespective of whether it is climbing or falling, and that is what will give you the best outcome in the mid to long term. Guys, thank you for watching. I hope you have a great end to your day, and obviously if you've got any comments or questions, please feel free to leave them below the video. Of course, please like if you enjoyed the content, and subscribe if you want to see more.